you fix part of your portfolio with a good fixed interest rate over the next 2 to 3 years. So that's what you have to look at. Now, the way you can do it, if you have a single mortgage, which is your owner occupied home, you might want to fix 50 to 70%, depending on what the size of the mortgage is, what's your risk appetite, what would be the repayment if interest rate go up by 0.25 to 0.5%. Why not fix 100% of it? Because fixed rate loans or fixed rate accounts cannot be offset. So that means if you have savings or surplus savings or capital or funds that you want to park against your mortgage, or you want to reduce the interest that you are paying by putting some money in the offset, you can't do that with most fixed rate mortgages. So what you do is you split your mortgage into two, probably 70% fixed, 30% in variable. So for $1 million mortgage, you will put 700,000 in fixed, 300 in variable, and you will link a offset account to the variable rate and put all the capital and funds that you have in that offset account, so that your interest expense on at least the variable rate is saved. If you have multiple mortgages, investment, owner occupied, then you would look at fixing maybe one mortgage altogether, or the principle remains the same, that you have to fix somewhere between 50 to 70% of your portfolio. Doesn't matter how big or small it is. So for multiple mortgages, whether to fix owner occupied property or investment property, our general advice is to fix the owner occupied property for two reasons. Number one, that your owner occupied mortgage, the fixed rate offer, is generally better on a owner occupied mortgage. So for example, at the moment, the best fixed rate that we are getting on owner occupied is 6.14. As compared to investment property, the rate is 6.29. So a 3-year fixed rate currently sits at 6.14, whereas 3-year fixed rate on investment properties sits at 6.29. So that's the number one reason why you would fix your owner occupied property or owner occupied loan and not the investment loan. Number two, if the interest keeps rising, the mortgage or the interest rate expense on your investment property, you can still offset it in your negative gearing or tax, which you can't on your owner occupied property. So owner occupied expense keeps going up, but you can't actually offset it in your tax. Whereas if the expense increases on your investment property, at least 30% of that, you can take it as a rebate on your tax returns.